Corporate Finance OneNote Practice Problem. In this presentation, we're going to work a practice problem in OneNote related to the calculation of turnover ratios, and we'll have a 2-year comparison of turnover ratios and turnover ratio data. Get ready. It's time to take your chance with corporate finance. Here we are in OneNote. If you would like to follow along in OneNote, you're not required to do so, but if you have access to it and would like to, we're going to be under the 331 Turnover Ratios 2-Year Comparison tab under the Practice Problems section. Closing this back up, we're going to have our information up top. We'll go over all the information first, and then we'll take components of that information as needed as we go through the practice problem. So we have in our information the sales for 2000X1, 4,300,000. Select data from our financial statements, which will be our balance sheet in this case, including cash, accounts receivable, inventory, net plant and equipment. That's our total assets. Then we will calculate the accounts receivable turnover, the inventory turnover, fixed asset turnover, total asset turnover. Then we'll have 2000X2 sales increase to 5,200,000 for the second year that we'll be taking a look at. Then we have the assets related to them, which will include cash, accounts receivable, inventory, net plant, and equipment. Okay, so now we have a smaller portion of our data in 2000X1 and 2000X2 on which we can calculate our turnover ratios. So we got our information accounts receivable turnover is our first calculation. So the accounts receivable turnover is going to be the sales divided by the accounts receivable. And we think about the sales, we're typically thinking the sales that are going to be credit sales. So we're assuming that all the sales here are credit sales. Depends on the type of organization as to whether their sales are basically all going to be sales on account, meaning they kind of like send out invoices and they're going to receive a payment on in the future, or cash sales, or if they have some mix of them, in which case we might have to determine the portion or estimate the portion that we believe are going to be credit sales. Also note that the sales is going to be an income statement account, the accounts receivable a balance sheet account. So because we have those differences in timing, time range, income statement, point in time, balance sheet, you might see this as sales or revenue divided by average accounts receivable, the most common average beginning of the year plus the end of the year, divided by 2. Note that that's still kind of an arbitrary number because you're still just picking 2 points in time and you're just trying to get some number that would be representative, but you can't really solve the fact that you're talking about 2 different time frames, one being a time range, the other being a point in time. So that's one attempt to kind of solve that problem. That's the most common one in something like a book problem. So note, I won't go over that every time, but most of the turnover ratios will be in that format, meaning we're going to have one balance sheet account, one income statement account. So you might have that, issue, and you might see the equation calculated as the balance sheet account being average, an average of which the most common average beginning of the period plus the end of the period divided by 2. Also note that the sales item here, you might see net sales from time to time. Don't confuse that with net income. Net sales means net of any contra sales accounts, such as a discount account, for example, which would act kind of like an expense, but it's really like a contra sales account. All right, so then we're going to have our data. We're going to say that we have let's do the calculation just so we can take a look at the rounding. The 4300000 divided by the accounts receivable, the 869,000. That's going to give us, if we round it, 4.95 about. So that's how many times the receivables are turning over in this time period. Now note, we want the receivables to turn over more, because if the receivables are turning over more, that means we're collecting on them sooner. And that's going to increase cash flow, and that'll make it more likely that we actually will collect on the receivables in general. Then in 2000X2, we've got the 5 million, so sales are up, accounts receivable up. Let's take a look at the turnover. So we got the 5,200,000 divided by the 937,000. That's going to give us the 5.55 about. So notice year 2 turning over faster, so that would typically be better, right? That would be a better thing. The sales are higher, so that is good. The receivables are higher as well. May or may not be good, right? Because we'd like the sales to be up and the receivables kind of to be down, kind of, because that would indicate that we're collecting on the receivables, collecting on more receivables. But if you take the ratio of the two, sales went up and accounts receivable went up, but sales went up at a higher basically rate, and therefore we have a higher turnover, which is good. So it's an improvement from 2000X1 to 2000X2. Let's take a look at the inventory turnover. So inventory turnover, we're going to be using sales. Now remember, with inventory turnover, you might see the calculation used with cost of goods sold. You might see it with sales. We went over an explanation as to why you might use one or the other in a prior presentation. Won't go into that now, but just note that you got to keep that in mind anytime you see the inventory turnover. And with all turnovers, you also have to keep in mind, as we discussed in the last one, that you have a sales income statement item, and then you have a balance sheet item, inventory, and therefore you might see it given as average inventory. You got to be aware of that. That's going to give us our inventory turnover. So let's go ahead and calculate this out. Obviously, the sales number is coming from our data up there. Inventory here, sales number for X2, and then the sales number, and then the inventory number. So let's divide this out. 4300000 divided by 417000. That's going to give us our 10.31 inventory turnover. Now, the higher the inventory turnover, typically the better there as well, because we want the inventory to be turning over. That means we're purchasing it and then we're selling it. We want to sell it, obviously sooner rather than later. So then we're going to say on 2000X2, 5200000 divided by 1041000. And so that's about 5, because we're rounding it. It rounds all the way over here. That's kind of a strange rounding, but the 5 rounds this up, and then we get a 5 even. Okay, so that looks like a pretty big decline here on the inventory turnover. So that would be not looking as good. Now, why would that happen? You notice the numerator went up, meaning sales went up. That would indicate that the inventory turnover would be increasing or going up, because now we're making more sales, meaning we're selling more inventory, you would think. But on the denominator, the inventory went way up. So why? How could that happen? How could sales be going up? So we're selling more inventory, and yet the ending inventory, the inventory on the balance sheet, is going up, even though sales is higher. Well, it looks like we purchased a lot more inventory, so maybe there was a discount on the inventory or something like that. This is something we would probably want to explain. When we definitely would, if we see a change like this, we'd want to say, okay, why would that be? Why did we purchase so much inventory here, and maybe there's a discount on it, or maybe we thought that it was a good time to purchase or something like that. So typically a decline, or it would be a decline in what we would want for the inventory turnover, because we typically want these turnovers to be high. So then we have the fixed assets turnover. So how efficiently are we using the fixed assets? Other names for fixed assets: depreciable assets, property, plant, and equipment. These are things like building equipment, that kind of thing. So we're going to be comparing, once again, the sales income statement number, top line of the income statement, to net plant and equipment, or depreciable assets, or fixed assets. These are names for the long-term assets, the depreciable assets, those large things, building, equipment, and so on and so forth. So comparing this out, and clearly we have the same thing, just like with all the turnovers. We got a sales item and a balance sheet item. So you might see then the balance sheet item indicated as net, or average plant and equipment, beginning of the period plus end of the period divided by 2, if you see that context. So then we're going to be saying that, let's divide this out. We got the 4300000 divided by the 517000. We've got the turnover of 8.32. Comparing that to 2000X2, 5200000 divided by 519000, we've got the 10.02. And so that's a good, right? That's good because the turnover is going up. Why is it going up? Well, we got the sales are increasing, so we would think that our fixed assets more efficiently in order to generate the sales, is the assumption that we're making there. The denominator went up too, but it didn't go up that much, and that's kind of normal more normal oftentimes for property, plant, and equipment, because we may not be purchasing a whole lot of like new property, plant, and equipment. We might be, if we're already invested in property, plant, and equipment, we may have a few periods where it doesn't change much, right? It's going to stay where it is because they're long-term They're going to be used for the long term. So therefore, if we have somewhat fixed amount of property, plant, and equipment, and the sales go up, that means we're utilizing the property and plant and equipment better. So for example, if we had a building, and sales went up, that would mean that we're utilizing the building more efficiently. If sales are down, then we're utilizing the building less efficiently, right? But we still have the same building there. It is what it is. The building, in other words, isn't changing a lot with the sales. So it's often the case that the building might stay somewhat constant if no added investment was put in place. And then obviously if sales went up, that would mean we would be using those property, plants, and equipment more efficiently. Okay, so then we're going to go to the total asset turnover. Now this is kind of like the overarching turnover because now we're looking at the total assets. We've been comparing accounts receivable, inventory, net plant, and equipment. All other, other assets, not including, we don't have the cash here, but we got the other assets. And then we didn't do a turnover for cash. But then now we're going to do the total asset turnover, comparing the total assets, right? So now we're going to say the sales number, income statement account divided by total assets. Once again, income statement account and balance sheet account. Therefore, the balance sheet account, you might be seeing it as average total assets. And then we're going to have our turnover. Let's do the calculation on it. We got the 4300000 divided by 1973000. We're going to get the 2.18 about. So once again, we want these to be higher, would be better. That would be meaning that we're using our assets in order to generate revenue more effectively. The assets are what we have, of course, in the business. They're kind of like our investment. We either got those assets possibly with capital, with equity, ourselves investing into it as the owners, or through loans, right? But whichever way we got it, now we've got the assets. How efficiently are we using those to generate revenue is going to be the idea here. So once again, you want these numbers to be higher. So if we compare that to 2000 x2, we got the 5200000 divided by the 2664000, and that's going to be the 1.95. So it went down a little bit. We used it a little bit less, the assets a little bit less efficiently. And you might ask, well, how could that happen? Well, the sales went up, so you would think that would be increasing the turnover ratio because the sales going up would be good, but the assets also went up. And this is where it gets kind of confusing because you're probably thinking, well, assets went up, that's good. And normally it is good that the assets go up, but notice the assets going up in the company, if we're going to hold on to them into the company, the reason they're in the company is to generate revenue. They're in the company to generate revenue. If we can't use the assets and we don't need them for any reason in the company, we should be giving them to the owner in the form of dividends so that they can then invest them somewhere else to earn a return on it, right? So when we're thinking about the assets of the company, we're thinking, are these assets getting a return on them? So if we have a lot of assets and they're not getting the return, then we're saying then those assets aren't being used efficiently, right? And they might be used efficiently outside the company in terms of dividend. So in any case, the assets went up. That's the denominator, and that's why the turnover went down. So when you think about this, you can think, okay, so here's the total asset turnover. It went down, and we compared the turnovers for the receivable, the inventory, and the net plant and equipment. So, and they're all kind of subcategorizations, right, of the total assets turnover here. So how could this have happened based on the other turnovers? Because the fixed asset turnover was good. It went up. So it wasn't the fixed asset turnover. It was really the inventory turnover that actually brought things down. All the other turns were actually good if you look at them, right? We got the accounts receivable turnover it went up, right? Not by a whole lot, but it was better. But then the inventory turnover went down a lot. So, and that pulled down the total asset turnover. So that's what we would want to justify when we're looking at these types of ratios. Why did this happen? Well, sales went up. That wasn't the problem. Inventory went up, like by a lot. Why do we have so much inventory? Like, why did we buy so much inventory and are overstocked? There might be a good reason for it. Maybe there was a discount, or maybe we foresee some problem with the inventory in the future and we want to get it now before the prices change or something like that. But that'd be kind of the justification you'd probably want to take a look at if you were justifying the ratios and explaining the decision-making process taking place.